Thank you very much, ladies and gentlemen. There is a meeting of the Federal Open Market Committee FOMC scheduled to take place today at 2:30 p.m., which is considered the Super Bowl of finance. We are only a few hours away from understanding exactly what is going to take place regarding rate hikes, rate cuts, or maintaining the status quo. At this point, we already know the predictions that range from 0.25 to 0.5. There have also been some wild forecasts that have been coming our way. It is going to be a topic of discussion. Going forward, we are going to deal with it. In addition to that, we are going to discuss the reasons why Jerome Powell, commonly known as the chairman of the Federal Reserve, would be looking to pump these markets. You are now entering the channel. One and all. This is Nick, my name. This also provides us with some insights into what is going to be happening around virtually everything, including our economy as a whole and our financial system as a whole, and it most certainly does have some implications when it comes to countries other than the United States. So make sure you don't miss out on this moment. In addition to this, we now have over here. Officially, it is the Fed. The day markets are getting ready for the most contentious Federal Reserve meeting since 2008. Indeed, this is the most extensive meeting of the Federal Open Market Committee. In a sense, since the year 2008. Really, it's quite insane. Currently, the majority of investors are of the opinion that the Federal Reserve should reduce interest rates by 50 basis points. You don't want a rate cut of 50 basis points, according to history. And this is something that I also mentioned the other day. Here are the reasons why. At the moment, 65% of investors are of the opinion that the Federal Reserve ought to reduce interest rates by 50 basis points over the course of the past 4 decades. The Federal Reserve has only ever begun a rate reduction with a reduction of 50 basis points on 2 separate occasions. One may see that the S&P 500 did not have a successful conclusion by looking at this chart, which is located here. This is the conditional meeting probabilities that are displayed by the CME Fed Watch tool. We have here a graphic that summarizes all of the interest rate reduction cycles that have occurred since 1995. This is providing us with insights on, for example, what proportion of investors believe that we should see a 50 basis point increase if we come down here. In the 2 most recent instances, the Federal Reserve began by lowering the S&P 500 by 50 basis points. All rate cut cycles that began with a 25 BPS cut have positive returns over the course of the next 12 months, and yes, this is exactly why. The savings range from 15% to 22% over the next 12 months. To tell you the truth, I absolutely do not think that we are going to begin with a 50. As a matter of fact, I ought to say that the initial cut should be 50% because it does not make any sense to me. To be honest, it doesn't. It is likely that we will receive the 0.25%. It's likely that we pump for around a year straight. Most of the risk associated with asset classes, such as cryptocurrency, will most likely reach its peak earlier. What I'm really looking at is the first quarter of 2025, which is essentially equivalent to the second quarter of the same year. Once more, I could be mistaken about that, but it is the general time frame that I have in mind. But we also have it down here that every single rate cut cycle that starts with a 50 basis point reduction in the interest rate occurred during a crisis. In 2001, during the height of the dot-com bubble, and in 2007 amid the great financial crisis. Unless the economy was experiencing a serious crisis, the Federal Reserve has always opted to reduce interest rates by 25 basis points at the beginning of each rate cycle. The following table presents the returns of rate cut cycles over time for the S&P 500, which did not begin with a cut of 50 basis points. Historically, it has been found that beginning with a 25 BPS cut resulted in an average return of approximately 10% or more for the S&P 500 in a period of 3 months. That represents the typical annual return of the S&P 500 over a period of 3 months. This would be a huge return on the S&P 500, especially when we take into consideration the fact that we are currently at all-time highs in terms of stock prices. And indeed, if we actually look at this, it would be a significant return. In the end, history reveals that a reduction in interest rates of 50 basis points is only required if we are about to enter a recession. In the event that we are not about to face a recession, the Federal Reserve ought to reduce interest rates by 25 basis points. Depending on whether or not a recession occurs, the changes in return after a rate cut are enormous, as demonstrated below. It has been stated by a great number of individuals that we are already in the midst of a recession. And that is pretty much it, right? We are currently experiencing a recession. The economy is not going into a recession. The economy is not about to enter a recession. In a technical sense, we are already involved, and I concur with that assessment. Certainly, I have done so. In spite of the fact that I believe the warning indicators are already present, these markets continue to be supported by other factors. During the selection year, they are helping to prop up the markets. There is a good chance that we will receive the 0.25 basis point rate drop. The rationale for this is because during the course of the next approximately 12 months, the markets in the stock market will perform exceptionally well. They are responsible for keeping everything afloat. And all of a sudden, boom, the most catastrophic crash that has ever occurred takes place. We should discuss this. I believe that to be a common sense. On the other hand, historically speaking, the S&P 500 has returned plus 15% on average within a year of the initial rate cut, provided that there is no recession. In the event that a recession occurs, the S&P 500 will, on average, suffer a loss of 15% in the first year. To avoid a significant market decline, which many people believe is probable, the Federal Reserve needs to perform a soft landing. Following the decision made by the Federal Reserve on Wednesday, the market is currently implying that the S&P 500 would move by around as much as minus 100 points. This is a growth of 1.8%, which is equivalent to 20% of the index's typical yearly return in just one day. We are going to engage in trading with our premium members over this volatility direction. Let us now pay attention to the fact that at the end of the day, we are hearing some real pressing of what Chair Powell ought to do. Now, for instance, Democratic senators are pressing the Federal Reserve to reduce interest rates by 75 basis points. I find it wild. If we give this some serious thought, if we were to reduce our spending by 50% at a time when we were facing a significant crisis or a recession, what would we call a reduction of 75 basis points? That is a really significant amount. The Federal Reserve is expected to reduce interest rates by 0.5%, according to JP Morgan. To reiterate, everyone is paying close attention to what JP Morgan has to say. I am referring to what, Democratic senators are saying or what Elizabeth Warren is pushing for, which is also 0.75%, and this is kind of connected to this as well. But the most important thing to keep in mind is that we will most likely receive the 0.25%. With all due respect, I believe that this is a fairly straightforward matter. I believe that this is the outcome that we obtain. This is a report from Citibank. In the year 2024, they anticipate a reduction of 1.25 basis points. To begin, as of today, we have 25 BPS. At the meeting in November, we received 50 BPS, and then in December, we received 50 BPS as well. Therefore, that would be 1.25 basis points, to reiterate. At this time, they also believe that there will be 50 basis points today in November and 25 basis points in December. One more time, the case for a reduction of 50 basis points is compelling. Once more, I would like to see the first one right now, which is 0.25. I believe that it would be reasonable to charge 0.50 in November and 0.50 in December. But once more, we need to keep an eye out, wait and see. Getting too far ahead of ourselves is not an option. Having steady money on the sidelines is the most effective strategy to get ready for this matter in the appropriate manner. I have, without fail, brought this up. A moment from now, we shall discuss some charts that are located here. In addition to that, we will discuss something that, apart from the actions taken by the Federal Reserve, I believe people should be paying attention to. In addition, the Federal Reserve is lowering interest rates after increasing them 11 times in the span of 16 months. The Federal Reserve maintained its standstill for an entire year. Inflation reached its highest point of 9% in 2022 and is currently below 3%. The new source of concern is employment. During the past 24 months, the number of jobs has been reduced by more than 1 million. From 210,000 per month to 142,000 per month, the number of new job vacancies has decreased. In addition, the unemployment rate has increased from 3.5% to 4.2% since July of 2023, which is another reason why a lot of people believe that we are now technically in the recession. Once again, this is the reason why. The labor market is cooling, which will result in a rate cut. Pow at 2 o'clock. Hold on tight. This is going to be extremely intriguing to see what happens next, so yeah, that. As I have stated before, I do believe that something will eventually break. To put it another way, when we consider what the Federal Reserve wants to do in this situation, they are in a dilemma. If I were the Federal Reserve, I would not want to be in this position. It is not at all. On the other hand, this is just what we were planning for. I would like to know exactly what I mean by it. To be sure, take a trip back in time to March of 2023. The retail sector is currently being misled into believing that their bank accounts are secure, that depositors will be protected, and that all of a sudden, in the world of finance, everything is going to be okay. Moreover, this occurred during a period in which numerous banks were declaring bankruptcy. Additionally, following it, there were even more bank failures that occurred. The fact of the matter is that the Federal Reserve is currently in a very precarious position.